Hello, good day. So, our lesson for today is balance sheet. So, so what is balance sheet? Balance sheet is a snapshot representing the state of a company's finances, what it owns and owes. What it owns is usually these are the assets, the cash, the property that the company use, and what it owes, usually liabilities, and the one who pays. As of the date of publication, because under balance sheet, it shows the financial position of the entity from where it started up to the date of its reporting. Okay? In some book, balance sheet is also called as statement of financial position. Next, it consists of real account. So remember, in our income statement videos, we said that income statement are nominal account. So what's again nominal account? Nominal account are accounts that revert back to zero every accounting period. Whereas real account does not revert back to zero. It accumulates over time. That's why balance sheet showed the financial position from where it started up to the date of reporting or publication. So it has three elements. It has asset, liabilities, and equity as balance sheet's element. And this also has call for an equation, which is asset is equals to liabilities plus equity. So what is this? So what the business owns is called assets. And what an asset is being financed by its creditor and owner. For example, uh, you as a student is being financed for you to go to what you own are your books, your shoes, your pants, your clothing. These are what you own. And normally, who bought that for you? It could either be your parents or you yourself when you work. Those are now financed by the owner. However, sometimes you are not lucky enough to have your own money to finance for your schooling or your parents. So you resort to a student loan. So these are now supposed to be paid once you graduated, and these are now financed by our creditor. So what is asset? Asset is a resources with economic value that are expected to provide a future economic benefit. And usually, these are anything that could be tangible or intangible that the company own and control to produce value. Okay? So usually it has three characteristics. Number one, asset usually represent ownership. For example, under land, you have the land title. It can be convertible. Convertible to what? Convertible to cash. And lastly, you could use it anytime. So it has two types, which is current and non-current liability. So let's now determine how do we know if it's supposed to be a current or non-current. So now let's determine how to determine current or non-current assets. So the first question is it realizable within the operating cycle? If it's yes, then it is current asset. If it's no, then another question, is it realizable within 1 year? If yes, then that's current asset. If no, that's non-current asset. So now, meaning, so a current asset should be realizable within operating cycle or 1 year, whichever is longer. If not, then it is now qualified as non-current asset. But what is operating cycle? Operating cycle is discussed in our other video, operating cycle. So just click the link below, okay? So let's do with the types of assets. So we already know that there are current and non-current assets. So under current asset, these are cash and cash equivalent. So cash, these are money and currency or cash in bank that are available for immediate use. So normally, the cash and cash equivalents, these are time deposit. But take note, it should be 3 months or less from the date of purchase. Next, you have accounts receivable. Receivable, these are legally enforceable claims for payment held by business for goods and services rendered to client but not yet paid. So actually, receivable usually the result of our accrual also. If there's no accrual or you are under cash basis accounting, you won't have any receivables. Next, you also have inventories. Inventories, these are goods in various stages. Remember in our income statement video, we have the merchandising. So it's only finished goods or merchandise inventory. Then for our manufacturing entity, you have the raw materials, the finished goods, and then the work in process. And then we also have prepayments. These are advance payment to our supplier or our lessor for advance rates or our insurance. And then anything that are not classified with the above or those that are mentioned will now be classified as other asset provided it should be realizable within the operating cycle or 1 year, whichever is longer. Next, non-current asset. So what is non-current asset? Non-current asset, we already defined it previously, but these are companies' long-term investment for which the full value will be realizable within more than 1 year of the accounting period. So example of these are investment in the company's intellectual property right or property, plant, and equipment. So normally the fixed asset, these are the property, plant, and equipment. Your furniture, your fixture, your computer, or anything that you usually use for the business that are tangible, but to be used for more than a year. Next, you also have financial assets. So financial assets, these are usually your investment. It could be investment in property, investment stock that you held until its maturity or more than a year. And then you also have intangible assets. So these are the intellectual property right, such as patent, brand names, trade names, and stocks. These are intangible because there are no physical subjects. So next, what's liability? So liability, according to accounting, is a present obligation of the entity arising from past event that the settlement of which is expected to result in an outflow from the entity resources embodying future economic benefit or economic benefit. So in short, these are debt owned by the company that required the company to give up either cash or asset to settle the past obligations. So it also has two types. So just like the current asset, you could also use that. To determine the non-current asset, you just have to check where it is realizable within operating cycle. If yes, current liability. If no, none. Is it realizable within 1 year? If yes, then current liability. If no, then non-current liability. Okay, so next is types of liabilities. We have current and non-current liabilities. So for current, we have the accounts payable. So these are money owned by the business to its supplier and the amount is due within the period. Next, we also have accrued expense. So these are liabilities that reflect expenses that has been already incurred but not yet paid. Then we also have provisions. These are liabilities that are uncertain to happen. It could be contingent or litigation, the loyalty cards, the warranties. These are provisions. Next, we also have unearned revenue. So these are revenue that has been paid but not yet rendered. So if you would see the accrued, the accounts payable, and the unearned, these are being put in the liability section to comply with our accruals. Next, we also have non-current liabilities. So non-current liabilities usually have long-term payable. Example of these are your mortgages and chattel and realty and bonds. So these are usually loaned from the bank for more than 1 year. Next, you also have the deferred tax liability. Deferred tax liabilities, these are tax assessed or is due at the current period but not yet paid. Okay, and normally, it has to be paid in the future. Okay, next, so what is equity? So equity is known as the residual, or in short, it's the leftover interest in the asset of the entity that remain after deducting its liability. So it's also called net asset because there is this equation which says that asset less liability is equals equity or net equity. Take note that usually the priority of payment upon liquidation, if the entity would be liquidated, normally the creditor, because the one who owns it would represent as financed by the owner. So since you are the one who managing the business or the owner has been managing the business, the creditor are given priority in terms of payment. So that's why you also have net asset. So it's your asset less all your liabilities is equals your equity or the portion of what you own in the asset. Okay? So next is equity. So equity has also classification, but actually the representation, it's just the same, except that per ownership, it would be different. So for sole proprietor and partnership, normally it's just the capital account. It's a capital, the name capital or equity account plus the owner's surname. Normally that's what it is. But for corporation, since there are a lot, so under here in the Philippine law, we have 5 incorporator and more than 1,000 of owner under the corporation. So we have ordinary shares. So ordinary shares, this is what you pay for each shares or the par value of each shares. So you also have premium on stock or premium on ordinary share. So these are what you paid on the top of the par value. Next, you also have the retained earning. Retained earnings has two kind. You have these are all the earnings that has been not declared as dividend, or all the net income that has been accumulated over the year but not declared as dividend. It has two kind. Number one is the accumulated earning that are unappropriated, so meaning it could be held for dividend, and the other one is that are appropriated, that are normally used for some other like dividend payment or capital expenditure of the entity. But however, for the accumulated retained earning, if it's too much, it now be subjected to tax under improperly accumulated tax. So okay, so we have now the pro forma sample of balance sheet. So you have to put the company's name, the name of the financial statement, which is balance sheet, or other could put it as statement of financial position. Then as of the period. Why as of? Because it is showing from the start until the period it's being reported. That's why it's as of, not for the year ended. Okay, because it's position, showing the positions of every assets and liability, or how much asset and liabilities and equity has been accumulated over time. That's why it is as of. So normally it's arranged as this one, and if you would see, the asset is arranged in order of liquidity, and we say that normally liquidity is the ability to be asset converted into cash. So for example, for cash and cash equivalent and trade receivable, if collected, it will now become cash. Inventory should be sold. Normally, it will go past receivable and then cash. So that's what the order of liquidity is. So this is for the total asset. Next, you also have for the total liabilities and equity. So it's this one. Then at the end, you have the total liabilities and equity that should always be equal to assets. Okay? Next. So we have now our sample entry. Let's try it. I lifted this from our unadjusted adjusted trial balance on our previous video presentation. So next, we had to get all the, we have now adjusted trial balance, and normally in the worksheet, from the adjusted trial balance, you'll be able to do the income statement and then the balance sheet. But we focus on the balance sheet. If you would check the income statement, it would not be balanced, and the balancing figure are normally the net income. And since the net income is close to balance sheet, the income statement and the balance sheet should have gained the amount of the actual net income, which is 51,583.33. So we have the lay company, the name of the entity, lay company, then its balance sheet or statement of financial position. We report it as of December 31, 2019. Then we have the asset. Current asset, we have cash, 61,000. Accounts receivable, 75,000. And supplies, 2,000. So we have total current asset of 138,000. For non-current asset, we have only one, computer, less the accumulated depreciation, because we know accumulated depreciation is a contra asset account. So that we would determine how much is the real value of computer at the end of the period. So we have 25,000 computer less accumulated depreciation. It's now 18,583.33. In some book, it could be presented as net. Net computer equipment net. Then you just have to put it on the notes to financial statements. Next, we have liabilities. If you go to our worksheet, it don't have any non-current liability. So we only have two liabilities, salaries payable and unearned, which is 10,000 and 5,000. So total of 15,000. Equity, we close all the equity account, which is the net income, and the withdrawal. So overall, Lay's capital only amounted for the next period at 141,583.34. So the addition is from the net income and withdrawal. Then we have now the total equity plus the total liabilities will give us the 156,583.33, which is also our total asset. So meaning total asset is financed by liability 15,000 and equity or the money of Lay, the owner, which is 141,583.33. Okay? So if you don't have any question, thank you so much. If you like this video, please hit the subscribe button and God bless you all. Comment if you have any question. I'll reply to you as soon as I can.